The US Federal Reserve has moved to help tame soaring inflation by announcing the sharpest rise in interest rates in over 20 years. The Fed's benchmark interest rate has been raised by half a percentage point to a target range of between 0.75% and 1%. The central bank has also sent a strong signal that it intends to increase borrowing costs by a similar amount at its next two meetings. The latest rate hike is the Fed's biggest since 2000 and follows a quarter of a percentage point increase in March as it embraces a more aggressive approach to tackling high inflation. Across the pond, the Bank of England also raised interest rates this week, raising its benchmark a quarter point to 1%, its highest level since February 2009, while Australia's Reserve Bank stunned analysts with a 25 basis points rise to 0.35%, the first increase in more than a decade. India's central bank also surprised pundits with a 40-point hike, taking its benchmark repo rate to 4.4%. Fed Chairperson Jerome Powell is warning that tighter monetary policy could lead to a slowdown in business activity and job losses.
The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this. And so what our tools do is that as we raise interest rates, demand moderates and it moves down. Interest rates, businesses will invest a little bit less, consumers will spend a little bit less. That's how it works. But ultimately, getting supply and demand back in balance is what gives us 2% inflation, which is what gives the economy a footing where people can lead successful economic lives and not worry about inflation.
Let's get more on this now with Massimo Massimilla, who joins us from Milan. He's a partner and chief information officer of alternative strategies at Albemarle Asset Management. Welcome to the program, Massimo. Just last year, the Fed was saying that the problem of high inflation would just be temporary, that it would come down in the coming months. But here we are now, we're seeing record high inflation across the globe. Now, in response, central banks are raising interest rates. Can you explain to us how will higher interest rates help to bring down inflation? And do you believe it's the right approach?
Yeah, absolutely. So thank you for having me, first of all. Last year, central banks talked about transitory inflation. And to be honest with you, they lost quite a bit of credibility by saying so, because as we can see, inflation has not been transitory. Inflation comes from an imbalance between supply and demand. And here, what we've had in the last couple of years has been a double shock, a shock on supply and a shock on demand. Shock on supply means a shock on commodities, global trade, labor participation, energy costs, and at the same time, there has been a shock on demand. Central banks and governments got really worried about the pandemic when it started, and provided a lot of subsidies and support with you're going to remember basically checks, furlough schemes, low interest rates, expansion of central bank's balance sheet, and this double shock now creates the inflation that we're seeing.
Now, central bankers are warning that the flip side to bringing down inflation through higher interest rates is a possible recession for those economies. It is a paradox, isn't it, that one of the antidotes to higher inflation, higher interest rates, could actually bring on an inflation. Is there any other way around that? Must governments really cool down the economy, bring growth to, I guess, a slower pace in order to bring down consumer prices?
Absolutely. I mean, as I said, inflation is an imbalance between supply and demand. Now, the easiest way to lower inflation is to act on the demand. And so you increase interest rates, and this automatically brings down demand. This, however, has a cost because by cooling down demand, you risk creating a recession. To be honest with you, central banks are really late now at reacting to high inflation because they downplayed the risk last year. they want to increase interest rates. The market has already discounted, actually, a lot of rate hikes. But they're doing that at a time when there is already a slowdown happening. You talked about recession, but in many places in the world, as we speak, the economy has basically come to a halt. You may recall Bank of England yesterday said that in Q1 the economy grew 0.9%, but that is already going to slow to 0.1% in the second quarter. And Fabio Panetta from the ECB already said that according to the numbers they have, the economic expansion in the euro area has basically stopped during April, May, and will slow down further in June. So the recession that should be caused by interest rates, in reality, is already here.
Interesting. Now, rising inflation first emerged, as you touched on, as economies began reopening after strict lockdowns because of the pandemic. And we were in a situation where basically, as you say, supply wasn't able to keep up demand because of those supply constraints caused by those lockdowns. But why haven't things been able to improve? Why have they worsened?
Well, things have worsened because there are forces at play here. The job market has been very strong and very tight, both in the US and in the UK, and it's improving in the euro area. So this has given a further boost to demand that was already subsidized for most of 2020 and 2021. And on the supply side, unfortunately, with the war in Ukraine, we've had a new shock on supply that has caused higher energy costs and new bottlenecks in global trade and in commodities trade.
Now, as well as raising interest rates, is there any other ways or methods that governments could use to bring down consumer prices?
Absolutely. As you know, we go back to the definition at the beginning of our discussion. You can act on demand by raising interest rates. I would argue that demand is already, coming down for a number of reasons. So probably you don't need to act so much on interest rates. And this is very much what the governor of the Bank of England was trying to convey to fixed income markets yesterday. What he said was basically, he was basically telling people that the expectations you have for interest rates are pretty excessive given what's happening in the real economy. There are other things that you can do to cool down inflation. For example, increase labor market participation. In the US, there are 5 million people that are not in the workforce. This number came out today, in fact. Labor participation is 62% in the US, which is the same number as 1976. So there's a lot of people who are not working, and incentivizing, for example, participation to the labor force, this helps cooling down inflation, as well as removing bottlenecks in the supply of energy, supply of commodities, and removing bottlenecks, related to trade between countries, for example, so that companies can have a smooth supply chain. This helps also inflation. I do have to say, unfortunately, that in the past, all these factors, theoretically, they do have an impact. But it's also true that in the past, at the end of the day, the most effective tool to bring down inflation has been hiking interest rates.
Okay, Massimo Massimilla, we will have to leave it there, but it was really good to get your analysis. Thanks again for joining us here on Money Talks.
My pleasure.